Well, we got a milestone in the currency markets today that we want to talk about. The euro hitting parity with the U.S. dollar for the first time in 20 years. Let's bring in Jens Nordvig, founder and CEO of Exante Data. And Jens, you think parity isn't the last stop here? It's going to go through.
Well, we have an extremely unusual situation on our hands in Europe. Right? We have a war right next to the EU. We have Russia that is essentially trying to create as much pain as it can for the European economy deliberately. It's not a normal situation, right? And the euro is trading accordingly, not normal. It's 20 years ago since we were here last time. Last time it was because some very special capital flows. This time around, there's a very fundamental reasons why we're here. So there's not really any good reason to fade it unless we see something new on the energy front.
Jens, it's Tim. How about the dollar-yen component of the dollar's move? Because BOJ's been missing in action, claiming they see zero inflation there. And while the dollar basket is certainly 60% euro, the move in dollar-yen has been extreme. I'm just curious if you think that's going to give ground.
Yeah, so if you look at this year, initially, the dollar was strong because the Fed was hawkish and a lot of currencies that were very sensitive to Fed policy moved a lot, such as dollar-yen. In the last couple of weeks, we've started to see something different. Dollar-yen is starting to stabilize a little bit. And what you're seeing is that it's the growth-sensitive currencies, especially some EM currencies, that are taking a major, major hit. So we're in a transition phase. The dollar has been strong through both phases, but it's strong against different currencies. And we're having something that smells a bit like an EM currency crisis now, really for the first time in a long time.
Yeah, that was going to be my question, Jens. Emerging markets, obviously, you're going to get eviscerated on the back of something like this. EEM is going, I think, from 60 down to current levels over the course of about a year and a half. I mean, how does that play out? Because, quite frankly, it can't be bullish here back in the United States at a certain point.
Yeah, so I think what worries me about this cycle, right, is that normally when we have significant pressure on asset prices, we have somebody is going to come in and help, right? We are used to the global central banks coming in and helping, or China coming in and helping. China's trying, but not very successfully, to get something going in China. And then you look at all the global central banks, they're still in tightening mode. We're not going to have like a big pivot from central banks like soon, right? Maybe we'll have something later this year, but for now, the central banks are kind of forced to stick to a hawkish tone because the inflation is so high. So that's what's worrying, that this could be a pretty drawn-out situation with not really any clear catalyst for relief, I would say, in the next couple of months.
Are we going to start talking, Jens, about, I don't know what the way today you refer to, pigs. Once upon a time, we talked about the pig countries and their debt loads. And I'm wondering if that becomes an issue once again here.
Yeah, so we've already seen that the sovereign bond spreads in Europe have widened out pretty meaningfully this year. And the ECB is preparing a certain tool to fight that already, right? So this is already a concern. And as long as the ECB is in tightening mode, which will be the case as long as the inflation it doesn't look like it's coming down very materially, that's going to be an issue. And that's also something that was different. Like 20 years ago, when the euro was down at these levels, we didn't have sovereign bond spreads blowing out. It was actually a pretty orderly decline all along. So from that perspective, this move here is quite a bit more concerning than the one we had 20 years ago.
Wow. Jens, good to see you. Thank you so much.
Thank you.
Jens Nordvig, Exante. Tim, I'll go to you since you're the ambassador. When it comes to the EM, when it comes to, parts of Europe, where are you most concerned about right now?
Well, I'm very concerned about Europe, and only two other times in the history is inflation adjusted has dollar ever been this strong against all of its core trading partners. 2002, so where Jens is referring to, and back to 1985. But those are moments when something was breaking, and so we're at a place here where the dollar is going to force pain. And although a lot of EM currencies had made adjustments and they are floating freely and have not been afraid to already revalue multiple times in the last 5 years. I mean, look at the Mexican peso. peso. Look at levels on the Brazilian real. Look at, forget the Russian ruble. Look at the Turkish lira. I mean, these are conditions where we've seen this over the last 4 or 5 years. But there's no question to me, Europe's pain is something we're just getting going. And we talk so much about the currency translation into this earnings season, but we forget about the EU as the second largest economic zone in the world, and the impact on multinationals and what it means. And again, I think we are going to hear this from pharma companies. I think we are going to hear this from companies who rely on Europe, not just because of the currency dynamic. So these are extreme levels on the dollar. 2 other times in history, inflation adjusted, you should be concerned. And yes, as an EM guy, I don't think this is a moment that you're ready to start buying.
Steve?
When you look at 2 stocks that stick out for me, so you're going to see money flows into U.S. dollar. That means it's going to get worse. And if you look at Capri's cost basis is in euros, but they sell in USD. That and Trinseo, 2 names I own. I guess you should look over your portfolio and see what stocks you own have cost basis in euros and sell in U.S. dollar, and that's a right way trade that you want to be in.
Okay.
Makes sense to me, Melms. I mean, I think Steve looks great in all the Capri Holdings attire, number one.
I thought you were going to say Capris.
Those as well. But, I think it's a bigger, it's just much bigger than individual stocks. I mean, Steve is right in terms of those names, but this is a big deal. Now, I think what might happen is, these numbers come out, not as hot as people think. You get a relief rally, maybe on the back of bank earnings. If the market does rally, I think the dollar will sell off, and that will assuage some of these concerns. I think that will be short-lived. I think the dollar will be continuing to go higher from here in the weeks to come.
So what I think about is companies, when they report and they have this FX hit, right? We saw Microsoft is sort of one of the sort of flagship ones to do it. Sometimes the market doesn't seem to care. They just sort of back it out. And
but
sometimes
now they do.
Now they do. They really do. And so I think, Steve's point about looking, what do you own? Where do they source? And where do they sell? So I think it's something like Target. They source somewhat overseas and they sell here. So that's better. Walmart also sources a lot overseas, but they have more of a mixed where they sell. So repatriating those lesser dollars when they sell overseas. So I don't know. I feel like in a good tape, market doesn't care, but now they will.